Most people want to grow their money, but they don't know where to start. Savings in the bank feels safe, but inflation quietly eats it every year. 1 lakh rupees today will not have the same power in 10 years. Some people jump into stocks without knowledge, without patience, and without a plan. They buy when markets are high, they panic when markets fall, and they quit before wealth actually builds. But there is another path, a calmer path, a disciplined path, used by millions of investors. Not by guessing the market, but by following a simple system. That system is mutual funds. If you understand just a few basic steps, you can start investing even with 500 rupees and build serious wealth over time. In this video, I'll show you the complete beginner roadmap, step by step. No confusion, no hype, just a clear system anyone can follow. This video is for educational purposes only. I am not a SEBI-registered investment advisor. This is knowledge, not personal financial advice. Markets carry risk. Returns are not guaranteed. Do your own research. Consult a certified professional if needed. Your money, your responsibility. Step 1. Understand what a mutual fund actually is. A mutual fund pools money from many investors. This money is managed by professional fund managers. They invest in stocks, bonds, or other financial assets. Instead of buying one stock yourself, you indirectly own dozens or even hundreds. For example, you invest 5,000 rupees in an index mutual fund. That fund may hold companies like large Indian corporations across sectors, so your risk is spread out. This is called diversification. It reduces the impact of one company failing. Step 2. Start with SIP. SIP means Systematic Investment Plan. It simply means investing a fixed amount every month. For example, 2,000 rupees per month, 5,000 rupees per month, or even 500 rupees per month. Every month, the investment happens automatically. When markets are high, you buy fewer units. When markets fall, you buy more units. Over time, this averages your purchase price. This is called rupee cost averaging, and it removes emotional decision-making. Step 3. Choose the right type of mutual fund. Beginners should keep it simple. 3 basic categories are enough: index funds, large-cap equity funds, and hybrid funds. Index funds track a market index. They are low-cost, transparent, and simple for beginners. Large-cap funds invest in stable companies. These companies are usually market leaders. Hybrid funds mix equity and debt. They reduce volatility. For a beginner, simplicity always wins. Step 5. Respect market cycles. Markets do not go up forever. They move in cycles. Bull markets and bear markets. During bull markets, returns look easy. Everyone feels confident. During bear markets, fear spreads everywhere. But disciplined investors understand one thing. Market falls are not enemies, they are opportunities to accumulate units. If you continue SIP during market downturns, you buy investments at lower prices. This is how long-term wealth compounds.
Step 6. Rebalance your portfolio. Over time, some investments grow faster than others. Your original allocation changes. For example, your portfolio started with 70% equity. After a strong market run, equity becomes 85%. Risk has increased. Rebalancing means restoring your balance. You shift some gains into safer assets. This protects your portfolio from sudden crashes. Experts usually rebalance once a year. Step 7. Understand basic taxes. In India, mutual fund taxation depends on holding period. For equity funds, holding more than 1 year is considered long-term. Long-term capital gains above 1 lakh rupees are taxed. Short-term gains have higher tax rates. Debt funds follow different tax structures, but the core lesson is simple. Long-term holding reduces tax impact. Frequent buying and selling increases it. Step 8. Avoid common beginner mistakes. Chasing last year's top-performing fund, stopping SIP during market crashes, checking portfolio value every day, switching funds too often, expecting quick profits. Mutual funds reward patience, not impulsive behavior. The best investors follow boring consistency. Step 9. Scale your investments slowly. Start small. Build the habit first, maybe 2,000 rupees per month. Then increase as income grows, 5,000 rupees per month, 10,000 rupees per month, 20,000 rupees per month. Small increases over years create massive impact. Compounding works quietly but powerfully. Time in the market matters more than timing the market. Step 10. Adopt the long-term mindset. Wealth through mutual funds is not built in months. It is built over years, sometimes decades. The investors who win are not the smartest, they're the most consistent. They invest regularly, ignore noise, and stay invested through cycles. Discipline beats emotion every single time. Closing. Your financial life changes the moment you stop guessing and start following a system. Mutual funds are not magic. They're simply a disciplined framework. Invest regularly, stay patient, respect risk, and think long-term. One day, years from now, your future self will look back at the small SIP you started today and feel grateful. Because wealth is rarely built in big moments. It is built in quiet monthly decisions. Stay consistent, stay calm, and let time work for you.